Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, tax strategist. Today we're unpacking how recent and upcoming tax changes hit real estate investors and how to respond. My goal, keep you compliant, shrink your tax bill, and boost after-tax returns without putting you to sleep. We'll cover depreciation plays, STR rules, rep status, 1031s, installment sales, energy incentives, state landmines, and more. Grab a coffee, open your spreadsheet, and let's turn tax anxiety into tax advantage. First, what's changed? The OBIBA, signed into law on July 4, 2025, permanently restores 100% bonus depreciation for qualified property acquired and placed in service after January 19, 2025, reversing the phase-down that would have reduced it to 40% in 2025 and eliminated it entirely by 2027. The phase-down percentages that once defined our planning calendar are now history for qualifying assets. Section 179 expensing was also significantly expanded, with the annual limit rising to $2.5 million and a $4 million phase-out threshold for property placed in service after December 31, 2024. Let's ground exits. Long-term capital gains get preferential brackets, plus a potential 3.8% NIIT if your MAGI exceeds thresholds. Real estate adds a twist. Unrecaptured Section 1250 depreciation is taxed up to 25%, separate from your long-term rate. On sale, your gain splits. $1,250 up to 25%, NE $1,245 from cost seg at ordinary rates, and the rest at 0%, 15%, or 20% plus NIIT. Model each slice before listing. Depreciation drives outcomes. Cost segregation reclassifies components to 5, 7, and 15-year lives, unlocking acceleration and partial bonus even as rates fade. Timing matters. Placed in service sets your start. Often furnishings and a first listing suffice. ADS versus GDS. ADS lengthens lives but can help with interest limitation issues or certain foreign owners. The 163J real property trade or business election frees interest, but locks you into ADS and forfeits bonus on some classes. Run the math. Short-term rentals are a unique animal. If the average stay is 7 days or less, you're not a rental activity for passive loss rules. With material participation, losses can be non-passive even if you have a W-2 job. Hit a test, 500 hours or 100 hours, and no one more than you, or substantially all. Keep logs, calendars, emails, platform records. Separate owner tasks from property managers. Audit-ready files often decide whether those losses shelter high-earning income. For long-term rentals, Real Estate Professional, AREP status, can unlock suspended passive losses. You need 2 tests, more than 750 hours in real property trades or businesses, and more than half of your personal services for the year in those activities. Then you must materially participate, often achieved via a grouping election, to treat all rentals as one. Keep contemporaneous time logs. Rep is powerful, but brittle. Miss a test and losses stay passive. Plan your year to hit thresholds. Repairs versus improvements determine deduction timing. Use the de minimis safe harbor. Expense items up to $2,500 per invoice per item, $5,000 with applicable financials if you have a written policy. The routine maintenance safe harbor lets you expense work expected more than once in 10 years for buildings. When you do improve, consider partial asset dispositions. Write off the remaining basis of removed components. Documentation, invoices, photos, engineer notes, supports calls. Strong capitalization policies routinely save investors 5 figures. Entity choice shapes liability and flexibility. For rentals, LLCs taxed as partnerships are the workhorse. Basis adjusts with contributions and debt, and there's no payroll complexity. S corporations often disappoint landlords. Rental income isn't subject to self-employment tax, and S rules restrict allocations and distributions, complicating refinances. C corporations create double tax risk on appreciation and payouts. Use disregarded LLCs for title holding and a partnership for multi-owner deals. Align structure with lender requirements, liability shields, and exit plans. Interest is deductible, but Section 163J can limit it for larger investors. If average annual gross receipts exceed the threshold, interest may be capped at 30% of adjusted taxable income unless you make the real property trade or business election. Points to acquire or improve rentals are generally amortized. On a primary residence, they may be currently deductible. Cash-out refinance proceeds follow tracing rules. Use funds for the rental to keep interest deductible. Track basis and at-risk amounts to preserve losses. Like-kind exchanges remain powerful. Identify replacement property within 45 days of sale and close within 180, using a qualified intermediary to hold proceeds. Use the 3-property rule, the 200% rule, or the 95% rule. Choose intentionally. Delaware statutory trusts and TICs can solve timing and debt matching, but review fees and control. Boot, cash received or debt not replaced, triggers taxable gain and often soaks up depreciation. Recapture first. Keep closing statements clean, route earnest money correctly, and coordinate depreciation schedules after the exchange. Installment sales spread recognition of gain as you collect payments, improving cash flow and marginal rates. But note, Section 1245 recapture from cost segregation is ordinary and taxed immediately, while unrecaptured 1250 and capital gain can be spread. Interest on the note is ordinary income, coordinate with state taxes. Some require upfront estimates. Draft notes with market interest, clear collateral, and prepayment terms. Model whether installment, 1031, or a clean sale best aligns with your liquidity and bracket outlook. Opportunity zones allow deferral of eligible capital gains invested into a qualified opportunity fund within 180 days, with tax-free growth on post-investment appreciation after a 10-year hold. Rules are complex. Substantial improvement tests, working capital safe harbors, and uneven state conformity. Energy incentives can be simpler for builders and multifamily. Section 45L credits for energy-efficient units and 179D deductions for qualifying envelope and systems. Documentation is king. Third-party certifications and engineering studies. These shine when stacked with cost seg and green-friendly financing. Your intent defines your tax world. Investors holding for rent or appreciation generally get capital gains on sale and avoid self-employment tax. Dealers and flippers, property held primarily for sale to customers, recognize ordinary income, may owe self-employment tax, and inventory rules deny depreciation. Facts matter: marketing, frequency of sales, quick resale improvements, and how you book the property. Use separate entities, bank accounts, and business plans to preserve investor status for rentals while isolating development or flipping operations. States add surprises. Property tax assessments spike after renovations or sales. Calendar appeal windows and assemble comps fast. Transfer taxes differ by city and can ambush refinances or entity transfers. Local occupancy, sales, hotel, or gross receipts taxes may hit short-term rentals. Filing requirements can include local returns, even when income taxes are zero. Track apportionment for multi-state portfolios and register withholding for non-resident owners. When in doubt, call the city clerk and document the answer. Plan your last move first. A step-up in basis at death can erase built-in gain and depreciation recapture. So many swap till you drop, using 1031s until a step-up resets basis. Coordinate with the sunsetting estate tax exemption. Gifting, outright via LLC interests or trusts, can shift depreciation, but beware loss of step-up and related party 1031 limits. Use buy-sell terms and valuation clauses. Align beneficiaries, debt coverage, and insurance to avoid fire sales. Case Study 1. A couple buys a small multifamily for $1.2 million, land $300,000. We run cost seg, move $250,000 into shorter lives, claim 60% bonus. They pursue rep. She's an agent logging 900 hours, and group rentals. Accelerated depreciation creates a $150,000 loss, $40,000 of suspended losses free, so $190,000 offsets his medical W-2 income. Cash flow positive, tax negative, a refund funds the next down payment. Case Study 2. An engineer with W-2 income buys an STR for $900,000, land $200,000. We furnish, list fast, and document cleaning, messaging, and pricing. Average stay is 4 nights. Cost Seg finds $180,000 of short-life assets. At 60% bonus, first-year depreciation is big. She meets the 100-hour and no one more than you tests. Result: a non-passive loss shelters W-2 wages while bookings cover debt service. Case Study 3, selling a rental with a $600,000 gain, including $160,000 unrecaptured $1,250 and $40,000 $1,245 from Cost Seg. Option A, 1031 into a DST to match debt, defer taxes and recapture, but accept fees and less control. Option B, installment sale, spreading $400,000 of capital gain over 5 years while paying $40,000, $1,245 recapture in year 1. Option C, cash sale, invest in an opportunity zone fund for tax-free growth. Action checklist: keep timely books, code repairs versus improvements, track WIP, CapEx by project. Maintain a depreciation file, Cost Seg, asset lists, placed in service dates, partial dispositions, calendar estimates, property tax appeals, and 45, 180-day, 1031 deadlines. Log hours for STR and REP, separate investor from management tasks, retain loan docs and tracing for cash outs, use dedicated accounts. Before you buy, finance, renovate, or sell, hire a pro tax planner to model scenarios with lender and counsel. That's a wrap for today. We covered shifting tax rules, capital gains layers, depreciation tactics, STR and REP pathways, repairs versus improvements, entity design, interest limits, 1031s, installments, opportunity zones, energy incentives, dealer versus investor lines, state landmines, and estate exits, plus 3 case studies and a clear action checklist. If this sparked ideas, don't wait for April. Bring in a professional tax planner to model your next move before you buy, finance, renovate, or sell. I'm David Robson. Thanks for listening. Share this with friends.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.